So dumb money versus smart money. Smart money position in theory, division 5. So smart money versus dumb money. We already understand that dumb money and smart money are doing the opposite of each other. So they're fighting each other. They're taking money from one another. Smart money is taking money from the dumb money pretty much all the time, collectively. Individually, sometimes smart money, sometimes dumb money individually, but collectively, it is every time smart money is taking money from dumb money. Okay? Now, what does this mean? This means that there must be an inverse correlation between their positions, because for me to lose money while you make money, say price went up. If I lost money and you made money from price going up, that means that I was short because I was losing money and you were long because you were making money. That is smart money versus dumb money. If price went up, dumb money was short, smart money was long. That's the inverse correlation between their positions. This means if smart money's positions were overly long, then that means that dumb money's positions were overly short. Here is where comes in open interest. So if you guys know what open interest is pretty much how many positions, unsettled positions, unrealized positions are running at this point. So if there's currently $1 million in longs that are not realized, that are still illiquid in these markets, then open interest is going to be at 1 million. Okay, there's 1 million in longs, so there's 1 million in shorts as well. So open interest is currently at 1 million longs, 1 million shorts. Okay. If there is open interest of $3 million, well, if there's a $3 million in longs, then there's open interest of $3 million. That is open interest. It's pretty much how many positions are open right now, unrealized. That is open interest. Now, how can we use this to understand accumulations and distributions? Well, accumulations is pretty much when the smart money is accumulating position. It's price moving in a fashion which increases the open interest. So if the open interest is increasing, that means that the smart money is accumulating a position. So if price is moving in a fashion which is causing the open interest to increase, that is smart money accumulating. If price is moving in a fashion which causes it to decrease, then that is a distribution. Now, let me show you guys an example of that, how it would look like in price. So let's just say price is displaying you this. Let's just say this is the optimal trade entry. So traders are looking to go short inside of this box. If price now goes up to here, it goes up to here, and it spends time here, the more time it spends here, the more open interest, the more the open interest is going to be increasing. Okay, so if there is, in this scenario, let's just say most of dumb money wants to go short where they stop up here, open interest among dumb money in shorts is going to be increasing, which means open interest among smart money in longs is going to be increasing. This means that the smart money is facilitating the dumb money's shorts over here, and this accumulation is causing open interest to go up. Open interest going up in this accumulation. Now, the distribution would be, open interest decreasing would be when price runs these stops. When price runs these stops, these positions get realized. The liquidity gets taken out of the markets, which will send the open interest right back down to where it was. That is accumulations and distributions. It's fluctuations in open interest. A spike up is an accumulation or a steady move up typically, and a spike down is a distribution. That is open interest. I will repeat it one more time. So when a lot of people are entering positions, then the amount of unrealized positions in the markets is increasing. Therefore, open interest is increasing because there's more unrealized positions. Now, if their stops are resting up at this point, if their stops are resting up there, then that means that once price reaches that point, these positions are going to be realized. So until price reaches that point, the open interest should be increasing. Once price reaches that point, open interest should be sent right back down. That is accumulation, price moving in a fashion which increases open interest. And this is distribution, price moving in a fashion which decreases it. Open interest is, if you could segregate the time frames, if that was possible, then it would be different among each time frame. But because you cannot segregate the time frames, you can only see the total positions coming into the markets, then the data we are receiving regarding open interest is very low resolution. This is why I teach you guys how to find it on the charts rather than get it from low resolution sources. Because if you were to combine the 1 minute with a 5 minute, with a 15 minute, with a 1 hour, with a full hour, with the daily, with the weekly, with the monthly, then you would get a very low resolution statistic. Like if open interest is going up, you don't know if that's relevant to the daily chart or weekly chart or full hourly or hourly. Maybe on the daily, maybe on the hourly chart, it's going down actually. You don't know, right? So you cannot segregate the time frames, and that's why the data you'll find online is low resolution in this for open interest and for positions in general. But I can teach you how to find it on the charts based off of theories, which give you which give you pretty accurate data. I mean, that's how I trade. I trade based off of speculations. I speculate how many positions are open. I mean, if there's more than, so let's just say I think there's more shorts than longs among the money, then I will think, okay, if there's more shorts than longs among the money, that means that smart money must be facilitating that with longs, which tells me smart money is long according to my speculation, which is how I acquire data, okay? So that is open interest, accumulations and distributions, the inverse correlation between dumb money and smart money. I hope it all makes sense. Before I continue over to the next slide, because we went over a lot of information, just react with a thumbs up if it made sense to you.